Our next speaker is Jackie O'Neill, who we already saw on a panel. She's the director of Microsoft Africa Research Institute. Jackie, welcome.
Hi, everyone. Okay, I'll start while I'm waiting for the slides. Aha, thank you. So financial inclusion is an old and important problem. There's various definitions, as we mentioned in the panel, but they tend to focus on access to financial services. And digital technology, given that the problem is access, is often seen as the panacea to financial inclusion. In this presentation, it's probably unsurprising to any of you, I'm going to problematize the idea of technology as being the solution to financial inclusion. Like Karen earlier, I'm going to talk about the importance of human infrastructure to financial inclusion, and then I'm going to reflect on the relationship between financial inclusion, access, and digital technology. So, a definition: access to timely and adequate credit, savings, payments, insurance by vulnerable groups when needed at an affordable cost is the definition of financial inclusion often used. But early research quickly showed that access is not enough on its own. This was typically research conducted on the Indian government's amazing mass banking scheme. They had a massive success at getting so many people banked, yet research quickly showed that most of those accounts are unused or underused. And Nelms and Ria actually said that they remain symbols of financial inclusion rather than practical tools. And the quote that I said earlier, it's a lot simpler if one has some money to use a bank account. So the definition of financial inclusion has been expanded to be the 5 A's: availability, accessibility, acceptability, affordability, and awareness. But despite this expansion, the focus on solving the financial inclusion problem remains largely technological. And I want to really problematize this by talking about the centrality of human infrastructure to financial inclusion. And I'm going to use an example from a study of auto rickshaw drivers who were taking out loans with a social enterprise to buy their auto rickshaws. It quickly became apparent that the payment mechanism, whether it's cash or whether it's digital, and they use both, was not the whole story or even the most important part of them paying off their loan. Rather, for this vulnerable community who are earning a small and unpredictable wage, it took an enormous amount of collaborative work between the auto drivers, their loan managers, and the social enterprise to enable them to successfully pay off what is a 3-year loan. If you can imagine the challenges people have in 3 years in their lives. The loan managers built in flexibility, and it was the contract between the managers and the drivers that enabled this loan to be paid off. Now, we did actually introduce technology. I don't want you all to think that I'm some weird anti-technology person who unexpectedly came to this conference. But the technology that we introduced basically helped the loan managers be more effective and to collect their knowledge about the auto drivers. And what was interesting about this is this enabled the social enterprise to build flexibility into their credit portfolio in a way they hadn't before, because now they had a sense of who are the drivers who are at risk versus the drivers who were just a bit behind because they had a normal shock in their payment and would catch up. So this is technology that amplifies the human work. And I would argue it's the human work on the ground of that social enterprise which enables financial inclusion, not digital payments or otherwise. And we tend to forget this. The rush to digitization excludes the most vulnerable. And we need to think about how do we enable that human social work of supporting payments, of financial education, and also less deterministic decisions about who's a good payer and who's a bad payer. Furthermore, the use of digital technology and digital payments doesn't necessarily equal meaningful inclusion. We found that digital payments sometimes were exclusive and were not beneficial to drivers, and drivers who were driving with Ola, this is India's Uber, they often would refuse digital payments because they didn't allow them the flexibility they wanted. But we also saw cases where digital money gave them advantages. It was actually inclusive. It acted as a money guard for them. They could save up money for a week or 2 weeks or even a month. But that was only because they were paid a mixture of cash and digital. So it's not digital money per se which supports financial inclusion. Access to formal financial services is really important, but formal financial services are not always better than informal financial services. And if you're eking out a living on an unpredictable low wage, you want as wide a portfolio and as wide an ecosystem of financial services as you can get. So we've got the 5 A's, which are the what of financial inclusion, but what about the what for? Even the best designed mobile money digital payment systems that should encourage financial inclusion can have detrimental effects at some time, as some research has shown. Again, I'm not against the use of technology, but I don't think it's the most important factor. And when we're designing anything, we need to ask ourselves, do the services improve well-being? How do they support the most vulnerable? And who do they exclude? And I can guarantee that every single service will exclude somebody. So it's really important to be intentional about that and then think about how you can mitigate it. So, at its most basic, financial inclusion is about money. It's about increasing wages or decreasing outgoings. It's a structural problem. And technology, as we all know, cannot solve structural problems on its own. There is no magic technological bullet. So what I want to leave you with is, when it comes to financial inclusion, if digital money is the answer, then you're asking the wrong question. Thank you.